Hello folks, Hector Deville here with a new video on intraday trading. In this video we are going to be reviewing one important concept on intraday trading. Well, I personally believe it's extraordinarily important, and that's the average daily range. Alright, the average daily range or average true range. You may see it expressed in both ways. Okay, it's basically the same thing. Average daily range, which will help us making sure that we are trading within the statistics, okay, or within what's statistically feasible. Well, first of all, let me define what the average daily range is, and then we're gonna move on to the actual uses, the actual benefits of the average daily range. All right, okay, the average daily range is the number of pips any particular currency pair moves within a trading session on average. All right, what you do is you simply pick the last X amount of days. I personally pick the last 7 days. All right, some of the traders prefer to calculate the average daily range based on the last 14 days. Again, my personal recommendation is just to pick the last 7 days. So let's assume this is price movement within the last 7 days. Okay, just get the last 7 days different trading sessions. All right, and then what you do is you simply pick the low and high for the day, count the number of pips, basically how many pips that currency pair has ranged for within that trading session. Let's assume 175 pips this day. All right, then you go move on to the next day over. This is the high for the day, the low for the day. This is the ending for the day, would be there. Okay, you calculate the range, and again, let's assume, I don't know, 160 pips. Then this is the low, this is the high. Let's assume 140. Right, this is the low. The high should be somewhere in there. Let's assume 100 pips, and so on and so forth. You would do exactly the same thing, basically calculating the range of the individual daily trading sessions. All right, and then just calculate that range, that span, that distance between the high and the low for that day, and then you simply calculate the average. As simple as that. Let's assume the average is, I don't know, 155 pips. Well, now we know that from a statistical point of view, we can expect that particular currency pair to move 155 pips on average. Well, maybe a little bit more, maybe a little bit less. Obviously, this is just a statistic, but at any rate, you know that it should be somewhere in the neighborhood of 155 pips. And again, now that we have that piece of information, what is it good for? Well, we are going to be using the average daily range in order to make sure, again, we are trading within the statistics, and that has two benefits. First of all, we are going to avoid being overly aggressive with our targets. Again, we are going to be trading within what's statistically feasible. All right, and second, we are going to maximize our profits as much as possible. Okay, we are going to squeeze our final profit, we are going to push our final profit as close as possible to the average daily range. All right, here's the idea. Well, there are two main benefits of the average daily range, which are these two. All right, both of them related to trading within what's statistically feasible, and then after that I will show you a third benefit of the average daily range. For the time being, let's focus on these two. Okay, first of all, we are going to avoid being overly aggressive with our targets. Okay, we are not going to push our targets beyond the average daily range. How is that? Well, because then we would be pushing our luck. Okay, if the statistics say that that particular currency pair moves 155 pips on average, you don't want to be pushing or to be locating your target beyond that level. Okay, 170 pips, 180 pips. You don't want to push your luck. Okay, you want to trade within what's statistically feasible or reasonable. All right, and second, it's going to help us maximizing our profits. Hey, why would you shoot for 130 pips if the average is telling you that that currency pair moves on a daily basis as an average 150 pips? If you only go for 130 pips, then you will be effectively leaving, well, these many pips on the table, right? You don't want to do that. You want to maximize your profits whenever you find an actual profitable trading opportunity. Doesn't that make sense? So the average daily range again is going to help us in both regards, avoiding locating our targets at overly aggressive levels, but at the same time helping us maximizing our profits. Alright, here's how you would go about that. Alright, now let's assume this is the intraday session, okay, the intraday trading session. Actually, this would be the beginning of the day and that would be the end of the day. Now, prices, well, simply moving on its merry way as it normally does. You, let's assume you sit on your trading desk at that time. I don't know, maybe that's 8 a.m. in the morning. You sit there and you begin monitoring price action, searching for a trading opportunity, and right there, okay, at that moment, you find a buy entry. All right, a buy entry. An entry, an opportunity to go long. As we've already determined, this currency pair moves 155 pips on average, okay, as per the average daily range calculation. Well, what you want to do is you want to figure out at what level do you want to locate your final target. How much or how far do you want to be pushing your target, okay, your profit-taking level? Well, what you do is simply, since this is a buy entry, you take the low for the day and add 155 pips to the upside, all right? And that would be somewhere around there. Obviously, if this was a sell entry, well, you would take the high for the day and add 155 pips to the downside. But since it's a buy entry, you want to expand, to project the average daily range to the upside, okay? And that takes us all the way up there. Again, as per the two benefits of the average daily range, you want to maximize your profit, or it's going to help you maximizing your profits because, well, you would not be placing your final target anywhere down here. Why would you shoot for this many pips? Is if as an average, the average daily range is telling you that this currency pair should move up to this area. You want to maximize your profit, push your and pushing your final target as as close as possible to the average daily range. But also in the same way, it also avoids placing our final target at overly aggressive levels, meaning that you don't want to push your target anywhere beyond this area, okay? You don't want to place your targets anywhere there, okay? Because statistically wise, chances are price is gonna lose momentum once it hits this level, and chances are it will either meander sideways or turn around, all right, altogether. But at any rate, again, from a statistical point of view, chances is it will never hit your final target, okay? There is nothing worse than seeing a profitable trade turning around before it actually hits your final target, okay? So that's the way we are going to be implementing the average daily range on our daily trading, intraday trading routine, all right? In order to locate our final targets at the most optimal level, again, around that average daily range calculation figure. All right? All right, now, well, before I said that there was indeed a third benefit of using the average daily range as an intraday trader, all right? And that's to avoid entering the trade too late. These two benefits are related to the profit-taking level. This benefit here is related to the actual entry level, okay? And again, it's going to help us entering the trade too late. Let's go back to the previous example, assuming, price, has been ranging. That's the beginning of the trading session. That's the end of the trading session, okay? Price has been moving on its merry way. That moment you sit on your trading station, you begin monitoring the price action. You find a buy entry at that moment, all right? A buy entry right there. Again, you take the low for the day. You project the average daily range to the upside, 155 pips. in this particular example, and that's where you want to be locating your target. Okay, your target, right? Well, now instead of assuming that you took your trade there, yeah, you found your buy entry in there, let's assume price actually gave you the entry when price was in there. All right, that's actually the level where this time around you found your buy entry. All right, on this particular trading scenario. Well, here's the thing. Please remember that the average daily range is all about trading within what's statistically feasible. We want to trade within the statistics. So, if we take our entry there and the potential target, okay, the potential exhaustion point for this currency pair, please mind that the average daily range, what it basically does, it simply tracks exhaustion points from a statistical point of view. Okay, so if the entry point it's kind of close to the exhaustion point, do you really want to take that entry? Is that really a good idea to take that entry, that buy entry, so close to the exhaustion point? Do you really want to do that? Well, sensibly speaking, no. The average daily range will also help you entering trades when it's too late. You don't want to take your trade, you don't want to enter your trade too late. In a previous video, we were talking about the timing factor and how important the timing factor is as far as intraday trading. Well, the average daily range can also help us nailing down the time factor from a statistical point of view. Once again, you don't want to enter a trade if that entry level is too close to the average daily range, because if you take your trade there too close to the exhaustion point, I mean, you are going to enter a trade just for what? 10, 15 pips? And are you going to risk price turning around, losing momentum all of a sudden against your direction, against your best interest, just to squeeze 10 pips out of a trade, 15 pips out of the trade? No, you don't want to take that trade. Okay, so the average daily range, or as per the average daily range, you would want to not take that trade at all. Okay, again, the average daily range is going to help you avoiding taking trades or entering trades too late. That's another fantastic benefit of the average daily range. All right. Well, so now you're probably wondering or asking yourself, how close is too close? Okay, what's the number of pips from the average daily range upon which I don't want to be taking trades no longer? Well, we are not going to calculate that in a certain or as per a certain number of pips. Okay, we are going to use a percentage, or at least I personally use a percentage myself. Here's the idea. Again, beginning of the day, end of the day, price ranges swings up, swings down. You sit at your trading station and you take you find your buy entry there. Well, buy entry there, all right? You project that 155 pips to the upside, somewhere in there. What you do is you calculate the current day's range, all right? This being the high for the day, this being the low for the day, and therefore this is today's, the current day's range, all right? And my rule of the thumb, if the current day's range is beyond 50% of the average daily range, again, this being the average daily range, this being the current day's range, the current daily range, sorry, okay? Average daily range up to here, current daily range up to there. So if it's beyond 50%, you don't take the trade. How is that? Well, because again, I mean, you want to have plenty of room to by the time you take your entry, you want to have plenty of room in order to locate your profits around the average daily range and to make the trade worthwhile. Again, you don't want to be taking your trades there just for 10, 15 pips. That's not a good idea. Okay, you don't want to enter risky trades for just 10, 12 pips, right? You want to have plenty of room in here to squeeze I don't know, 40, 50 pips, something that's actually, a trade that's actually worth taking. So my rule of the thumb, again, as a conservative trader, is 50%. Some other traders may be more aggressive, may expand or may push their luck up to 70% of the average daily range. That depends on how aggressive you are with your trading. All right. So I understand that some of you will be more conservative, some of you will be more aggressive. I am personally a conservative trader, okay, but again, I respect that you may be a little bit more aggressive with your trading. All right. So you may want, or you may be, I don't know, willing to push that percentage up to 70%. All right. Again, at no rate, please, guys, please do not push your luck beyond the 70%. Don't do it. It's just not worth it. You're gonna be risking your entries, okay, your trades. You're gonna be taking trades for just, again, 10, 15 pips. It's not worth it. All right. That's my rule of the thumb, again, 50%. If by the time I get my entry, the current daily range is beyond that 50%, I simply just walk away. All right. You need to control your discipline, know when the statistics are just not on your side. Please remember, average daily range is all about trading within statistics. Okay, you've got to understand that even if you find a trading, or if your system gives you a buy entry, not all those entries are going to be within what's statistically feasible, okay? And therefore, you want to override your system and to not take your trade. At the end of the day, you are a trader and you've got to take decisions, all right? And a system, it's fantastic. Systems work. Systems is what makes us money, but common sense, it's very important in trading as well. Okay, common sense is very important. So if your system gives you an entry way too close to the statistical limit, don't take it. Common sense, guys. Common sense. Don't take that trade. All right. Now, I think that's about it. I've pretty much beaten this horse already. Now, I know that for some of you making all these calculations on the average daily range, that 50% of the current daily range, all that mess, may be a little bit of a pain as far as calculating that, manually. So don't you worry, I'm going to show you now an indicator, a custom indicator. Again, that's been specifically coded for me by my programmer, my personal coder. That's gonna do it automatically for you. Okay, give me a second. I'm gonna pull up a Forex chart so I can show you the indicator live. Alright folks, we are now looking into the New Zealand dollar against the American dollar in the 15 minutes time frame intraday chart. We've already seen actually on a previous video this chart. This is current market price. Actually, it's the close of last Friday's trading session. As I record this video, it's Sunday. I always record my theory videos over the weekends, since I am trading from Monday through Monday to Friday. Okay, so I don't really have time to record this type of videos over the weekdays. Anyway, New Zealand dollar against the American dollar, 15 minutes time frame. You may have noticed that I have a special indicator on my screen. Okay, it's called the ATR projection. All right, and this is the information that we can get from this indicator. Today, the current day range is 83 pips. That means from the low to the high of the day, it's 83 pips, whereas the average true range, the average daily range, is already is 78 pips. That means that today we've already moved beyond the average daily range. Okay, we've already moved beyond the statistical average. The pip value is the value per individual pip if we are to trade one standard lot. That means that for the New Zealand dollar against the American dollar, in order to trade, if we are to trade one standard lot, every pip is worth $10. This has got nothing to do with the average daily range, but I figured it's a useful piece of information nonetheless. The average true range projection up, meaning to the upside, is 0.7219. basically what that is nothing but taking the low for today, adding the average daily range, in this case 78 pips, and it takes us all the way to 0.7819. Obviously, if throughout the day we found any buy opportunity, any buy entry, we would be looking to place our final target around that area. Okay. Conversely, the average true range projection down, we pick the high for the day, project or extend 78 pips to the downside, and that takes us to 0.7146, which would be our ideal location to, well, locate our final projection, our final profit target if we were to find a short entry, a sell entry. Okay. Now, also you will probably notice there are few lines, a few floating lines on my screen. Okay. These ones, the outer bands, are the 100% of the average daily range. Basically, the distance between these two bands are, well, it's 78 pips, okay? This is the 70% ADR bands, all right? 70% of 78 pips, well, that's what you get. And here is 50% of the average daily range. So if I am not mistaken, 50% of 78 is 39, correct? Yeah, 39 pips. So, well, that's exactly the distance from these two bands. Now, what is this good for? Well, in order to gauge whether we are too late to enter the trade or not. Here's how it works. If from the beginning of the day until, well, by the time you get your entry, let's assume we get our entry there, okay? If by that time price has broken, and at any time of the day, the 50%, the inner bands of the average daily range bars, bands, okay, meaning price has ranged beyond 50% already at any time of the day, that means that this trade is a conservative trade no longer. All right, price is not contained, has not been contained within the 50% anymore. Price, as we can see, well, it's already expanded beyond the 50% bands. Now, even though if price has broken through the 70%, 50% bands, we may still be okay if we are a little bit more aggressive with our trading, as long as price has not broken at any time of the day beyond the 70% bands, all right? Basically, these two bands here. But as we can see, price has indeed broken beyond the 70% bands, all right? In fact, as I was mentioning before, price has broken beyond the 100% bands because, well, today we've moved 83 pips and the average daily range is 78 pips. So today is a larger than usual trading day, okay? Or a more volatile than usual trading day. So if we were to find a buy or a sell entry, doesn't really matter, at that precise moment, should we take that trading signal, guys? If our system gave us the the indication to buy or to sell at that precise moment, should we take that trade? No, we shouldn't. Price has already broken beyond the 70% bands. Okay, this is just way too aggressive. In fact, we've already broken the 100%, so that's certainly a no-go. The best course of action is to not take that trade. All right. Okay. Now let me show you another similar chart. Okay. So we make sure we drive the point home. Just please bear with me one moment. All right. Another example, just to make sure we drive the point home here. Australian dollar against the American dollar, also on an intraday chart, the 15 minutes time frame. All right. Beginning of the day. End of the day. Again, going back into the average daily range, we can see how price in this particular example has already broken throughout the day the 50% bands. All right, please remember that the 50% bands are the inner bands. Okay, so if we took an entry right now, let's assume our system gave us a buy entry at this level, well, this would be an aggressive entry, so to speak, because price has already moved beyond the 50% band. Please mind that the way you read this indicator is not by seeing whether price is within the 50% band at the time of the entry, but actually at any point throughout the day. If at any point throughout the day price has already broken through the 50% bands, then we will be looking to at least make sure the 70% bands have not been violated, have not been breached at any point throughout the day. In this case, it hasn't. Okay, price hasn't broken the 70% ATR bands. So even though we've broken the 50, we are still okay-ish to take this trade. It is not a conservative trade anymore, precisely because we've broken beyond the 50% ATR bands. But, well, yeah, sure, it's an aggressive trade, but still is okay-ish to take that trade, because still we have room enough to hit the 100% band. Okay, obviously if price had broken throughout the day the 70%, anywhere in there, okay, at anywhere throughout the day, you wouldn't want to take that trade anymore. Okay, now assuming we took the entry there, okay, assuming that was our entry level, the indicator is already, let's assume also it's a buy entry, of course. The indicator is already well, pinpointing the projection to the upside, okay, the average true range projection to the upside, which in this case is 0.8981. Okay, basically the indicator, what it's basically done is to simply pick the low for the day and add 81 pips to the upside, and that takes us all the way. Actually, let me mark that 0.8981 right there. Okay, right there. Let me actually mark that. 81 right there. That's where we would locate, around that area, just a little bit before, obviously a little bit before. You don't want to put your final target beyond that level, so a little bit before, that's where we would put, if that was our entry, our buy entry, that's where we would put our final projection. Okay, the same way to the downside if it was a sell entry. Okay, 0.8875, which is somewhere in there. Somewhere in there actually. Okay, now as you can see, the projections, the projection is beyond the average daily range band. Okay, the 100% daily range band. That's because the 100% daily range average daily range band basically marks 81 pip, okay, from the lower band to the upper band. That's what it does. And now for the projections, we are adding those 81 pips to the low of the day. Since the low of the day has not broken beyond that 100% band yet, well, therefore we can expand a little bit we can extend our projection to the upside beyond the 100% band. At any rate, these bands are not static, guys. Okay, these are dynamic bands that update each other every tick, every minute or two. Okay, they float along price. All right, they float with price as the daily price action develops. Okay, so do not be surprised if these bands move throughout the day. They are meant to move, okay, throughout the day. Okay, don't you worry about that. The average projections, though, they don't quite move that much. All right, and that's basically it, guys. That's how you use this indicator. By the way, if you right click on the indicator on the chart and go to the indicator list, they go to ATR projections and click on edit. Here you can well, first of all, edit the average daily range period. As I was saying before, I personally like to set it to 7. You can change that if you want. My advice is to not do it. The inner and the mid average daily range bands, 50% and 70%, and the colors. Okay, the colors. Okay, now you can obviously edit that to your own likings. All right, folks, that's about it for this chart and for the average daily range. And well, as I was saying, that's about it for the average daily range. It helps you locating your final target at the optimal level, and also it keeps you away from entering the trade whenever your buy or your sell signal comes in too late in the day. Okay, the average daily range, fantastic tool. Please guys, if you want to become a successful trader, you've got to always keep in mind the average daily range as well as the round numbers, and especially what we are going to be seeing on the next video, which is precisely combining the round numbers in one hand, the average daily range in another hand, just to have the perfect work frame, the perfect mapping tool for the intraday price action. We are going to combine those two and you're going to be shocked. This is powerful stuff, guys. This is powerful stuff. Okay, so without any further delay, I'll be waiting for you at the next video.